Welcome back to our series on accounting journal entries. Today, we're going to dive into the journal entry to record cash received for services provided and discuss how the journal entry impacts the income statement and balance sheet. To make it more relatable, let's walk through an example together. On November 1st, Company ABC provided services at a price of $2,000 to a customer. The customer paid $2,000 in cash at the time of the sale. In this scenario, Company ABC provided services and received immediate payment in cash. To record this transaction, we'll use a journal entry. Now, let's break down the journal entry and its impact. In this journal entry, we have two accounts: cash and service revenue. Since the customer paid in cash, we debit the cash account to record the cash received. Simultaneously, we credit the service revenue account to recognize the revenue earned from providing services. Now let's see how this journal entry impacts the income statement and balance sheet. On the income statement, the service revenue account increases by $2,000, reflecting the revenue earned from providing services. The net income also increases by $2,000, assuming there are no expenses. On the balance sheet, under the assets category, the cash account increases by $2,000 due to the cash received. Under the equity category, retained earnings also increases by $2,000 due to revenue earned from providing services. And that's it for now. Don't forget to like this video, subscribe to our channel, and hit the notification bell to stay updated with our future accounting lessons. Thank you for watching and see you in the next video.